Hello and welcome to another episode of Darwin Investors. So, you might have noticed whenever you turn on the television set and watch a little bit of finance news that the hot topic of the day is whether or not the Fed is correct about interest rate hikes or whether the bond market is correct about interest rate hikes. In this video, we're going to talk about exactly what that means and historically who has been correct. And then next, we're going to talk about why the companies in our portfolios might shoot the lights out this earnings season. However, their stock prices might not budge much at all. And finally, I'm going to let you know what I'm doing and how I'm trading through this turbulent times. And just a spoiler alert, I feel like the market is going to be super choppy for the next few months. However, it's going to be range bound. So I'm going to be using some super high dividend yield, fixed income type of assets. And I'm also going to be looking for opportunities to grab a little bit of extra cash where I can with little options trades. And I'll show you how I'm doing that. All right, so let's go ahead and get into this. So when we talk about the debate between who's right between the Fed and the bond market, this all boils down to one word, and that word is recession. So the bond market believes that a recession is on the way, and in order to engineer a soft landing, the Fed's going to have to pivot. So the market has priced in a soft landing. The Fed, for their end, doesn't want easy money policies to come back, so they're posturing, and every time we get a little bit of good news, they send a Fed governor or Fed president out there to kind of throw a wet blanket on it and say, no, we're going to keep on tightening, because they don't want easy money policies to come back. So the Fed released their latest summary of economic projections back in December. So what they're projecting is for 2023, they're going to bring the federal funds rate up to 5.1%. And then once they get it there, they're saying they're going to hold it there for some duration. They haven't really said for how long, but they said at least through 2023, in which case that this is projected they're going to start pivoting and lowering interest rates sometime in 2024 to give us a terminal rate there in 2024 of 4.1%, and in 2025, 3.1%. We're currently sitting at 4.25% to 4.5%. So what that means is that at the next three FOMC meetings, that the Fed is expected to be raising their interest rates by 25 basis points per meeting for the next three meetings. So they think, so what the Fed is projecting is that they're going to raise it here 25 basis points at the end of January, beginning of February. They're going to raise it 25 more basis points in March and 25 more basis points in May. And so that'll get to their funds rate that they say that they're going to get to. However, the market doesn't quite believe that. What the market believes is that we're currently sitting here at 4.38%, and then they're going to raise it 25 basis points by March, and then they're going to raise it 25 more basis points by May or June. So they're only pricing in two more rate hikes. And so they have a terminal rate of 4.91%, but more importantly, they have a pivot coming before the end of the year. They say you're going to actually cut the rate 25 basis points sometime between June and October, and you're going to cut it an additional 20 basis points sometime between October and January, which is far different from what the Fed says that they're going to do. So who's right, and why does this even matter? Well, it matters because this is actually pricing in a recession. And if you price in a nasty recession, then the market's going to drop a lot further than if you price in a mild recession. So the significance is we want the bond market to be correct. So we've got this little chart here. It's the Fed funds rate versus the US Treasury yields. And the federal funds rate is this blue line right here that you see right here. It kind of goes up like that. And then the 2-year is this red line here. The 10-year is the gold line, and the 30-year is the black line in the middle. But what we're going to pay attention to here is this red line right here. And you can see that the red line will usually follow above the blue line, meaning that the 2-year Treasury is kind of projecting rate hikes in this case. Sometimes it'll project a rate cut, which is actually what it's doing right here. So now when it runs below the federal funds rate, it's projecting a rate cut. It's saying you're going to come down. And that's why they're saying that the bond market's playing a game of chicken with the Fed. But they're saying, given all the economic indicators that are coming through, that you're actually going to do a rate cut. And the Fed is saying, no, we're going to go up here. You need to bring that red line above that blue line. And if you look here historically, let's go 1 year. You can see the red line's always above the blue line. You see how they were projecting rate hikes, and the 2-year just keeps going up and up and up. And then now all of a sudden it's going below the blue line and said, we think you're going to cut. And if you look historically here, say over 5 years, the 2-year will beat the the 2-year beats the federal fund rates to the top, but then it like cut again right here, and it's like, okay, you got to come down, and that's what happens. Then the actual fund rate will follow. And this was during the funds hiking at the end of 2018, beginning of 2019. The 2-year got ahead of that, and then it got ahead of the downturn. And if you look over 10 years here, it's the same deal. It kind of follows it above. It kind of predicts rate hikes. And if you look here all time, it does the same thing. And you can see it here through the 70s. It would cut before, the Fed funds rate was up here, but it was like, no, you're coming down. And then of course it came down. And so this is something that plays out over and over and over again. But what we see historically here is that the 2-year is basically right every time. So the bond market is saying that the Fed is going to pivot, and they believe they're right because they've always been right. And because the market is smart, I mean, really smart, and they sniff this stuff out. But there's another reason why they believe it's going to pivot. And a lot of it came out from the earnings. These bank earnings shined a light on it. So let's watch this video real quick and show you exactly what happened a little bit from these bank earnings.
Then you've got Brian Moynihan at Bank of America saying our baseline scenario contemplates a mild recession, and Jamie Dimon over at JP Morgan, maybe a mild recession, maybe not. I'm simply pointing out that there are these geopolitical uncertainties which are real, and we've just had our eyes focused on them, and we hope they go away. They may not. The bottom line, Kelly, all of these big bank CEOs have a more conservative outlook about the economy in the coming months. I'll send things back over
Dom,
to
wait
you.
a minute. Let's look behind you for one more second. You have 3 of them all using the exact same term, mild recession.
Mild recession,
I don't like
yes.
that.
It's almost consensus at this point, which makes you wonder whether or not there could be a counter trend issue that develops in the next
It makes me think
moment.
we're either going to grow 5% or collapse to something much deeper. That's a great thing to highlight, though, Dom. Thank you. We appreciate it. Dom Chu.
So we have many rounds of layoffs through some of our biggest companies, and it's just going through everywhere. I say it's just through tech sector, but there are others out there. You got even McDonald's and Goldman Sachs and whoever. It's not just tech. We've got lots of layoffs going on. We've got the manufacturing index that came out to show that manufacturing is decreasing. We've got inflation that's coming down really fast, which is an indicator that things are slowing down. We've got a housing market that's frozen solid, and we've got probably more than all of that, we've got bank CEOs telling you that a recession is on the way. And for all of these reasons, the bond market thinks the Fed's going to pivot. But in addition to that, Jerome Powell is a human being just like you and me. Do you really think he wants his legacy to be the guy that turned the screws on the economy and causing an even worse recession where he could have been a hero and he turns himself into a goat? No, he doesn't want to be that guy. Nobody does. But in addition to all of that, the earnings have been revised way downward this quarter, also indicating that the economy is slowing down. And I've got this article that I'm going to go over. Now, the article is just pretty much all facts. I'll editorialize through it. I'll leave a link in the description of this article, but it's a nice article that kind of links everything all together. So let's go ahead and have a look at that. So this article comes from thestreet.com. It shows that earnings season could disappoint, but the bar is low. Let's look over the highlights of this here article. It shows that analysts' S&P 500 earnings estimates call for a year-over-year drop in Q4 results. It shows that a weaker dollar, lower commodity prices, and moderating labor costs could shift from headwinds to tailwinds as soon as the second quarter. And it shows that a declining earnings outlook could eventually make it easier for companies to beat expectations. Now, the weaker dollar might be, I saw something earlier this week that said, hey, there's no explanation for why Amazon's just getting pumped for no reason at all. It's a weaker dollar. Why is the NASDAQ going up like crazy? Well, they report earnings in 2 weeks and people are just kind of getting ahead of it. I wouldn't be surprised if a lot of these stocks, Microsoft, Apple, Amazon, Google, and the like, all report their earnings and they beat on everything because the expectation's been lowered so much. But then nothing happens because they're running so much in their earnings. Same with the banks. I was a little bit surprised to see them go up a little much. Now they all beat on earnings and revenue, but I wasn't sure if they would move at all because they ran so well into earnings. And I'm going to expect something similar out of the NASDAQ stocks. But anyway, what they're pricing in is this weaker dollar. And that's what I'm expecting out of the tech earnings. Now this guy wrote that that earnings and unemployment should be the focus in 2023 rather than inflation. And that we've already seen inflation moderate from sky-high levels last year. And so that's what we're going to be focusing on now. I think that the CPI reports have become less and less important, though I still think they're going to be kind of important until we actually get the inflation underneath 3%, which I think is going to be here by June. Although Q4 earnings results aren't likely to impress, overly bearish outlooks could set the stage for stocks to trend higher. We've got the bar very low, but what I didn't realize was how low this bar was actually set. They've gone from expecting low single-digit fourth quarter earnings growth to predicting the first decline in year-over-year earnings since COVID crimped corporate profits in 2020. On September 30th, analysts expected S&P earnings to grow by 3.5%. However, a larger than usual number of downward earnings revisions has them now expecting a fall of 4.1% from 1 year ago, the first drop since a 5.7% decline in Q3 2020. Downward revisions are common every quarter, but not to this extent. Using a bottom-up analysis of median earnings estimates, FactSet concludes that the EPS estimate for the S&P 500 have fallen by 6.5% since just September, far more than the average 3.8% drop in quarterly expectations over the past 20 years. So that's practically double of what is normal. So it is normal for it to come down, but it's just not normal for it to come down this much. Materials, consumer discretionary, communication services, and information technology have been hardest hit by the downward revisions. Analysts' outlook has soured for 97% of S&P 500 material sector stocks. As a result, the basket is expected to see fourth quarter earnings fall 26% versus an 8% drop in September. That's quite a steep decline. LyondellBasell Industries and Corteva have seen the biggest downward revisions. No big deal. Nobody owns those. Never heard of them. But the ones that people do own are these two here. Amazon and Target's lowered expectations are the biggest reason for an expected 20% drop year over year in consumer discretionary earnings. The outlook was for a 7.1% decline in September. Now that's a pretty nasty drop. It was supposed to be 7.1. Now here just a few months later, it's 20%. These are reasons why the market might think the Fed has to pivot. This is a pretty nasty drop over just a few months. Downbeat outlooks for Alphabet, Meta, and Walt Disney are most responsible for analysts' expectations that communication services earnings will retreat 19% from last year. In September, the estimate was only for a decline of 6.8%. Our economy is coming down in a big, fast hurry, according to these earnings estimates. Similarly, growing pessimism for earnings at Apple, Intel, and Microsoft is behind an expected year-over-year earnings decline of 9.5% compared to a manageable drop of 1.5% expected in September. This is 4 times more than what was expected. This is things are slowing down. The only bright spot is energy, which has propped up S&P 500 earnings throughout 2022. I think we all knew that, but what we don't really know is it's also expected to prop up the earnings through 2023. Analysts think energy earnings per share will climb 63% from 1 year ago in Q4. That's because while oil prices retreated, they remain higher year over year while production also increased. And this plays an important role about how I'm planning on just grabbing a little bit of extra cash. I might be playing some energy options coming up to try and keep my portfolio going upward. If we eliminate the positive impact of energy, then S&P 500 earnings would be expected to fall 8.5% in the fourth quarter. All right, fine. So if you got the index, that's fine. I mean, I always think it's funny to take something huge out of it like that. It's sort of like saying to Binance, if you eliminate all their debt, they're a very profitable company. But anyway, so that's just my little thing. But yeah, energy does have, at least from the short term, a very bright future. Overall, the level of earnings pessimism is concerning, but it also means that the bar for companies to overcome has been lowered. It's too soon to say estimates are too low, but contrarians are right to wonder if downbeat projections are setting up easier comps and poor earnings are already priced into stocks. I think that we're seeing a little bit of that as these stocks are they are running into earnings. It's not a coincidence that all these indices are running up while earnings are coming out, because poor earnings are priced in and these bars are pretty low for them to get over. And I think a lot of analysts believe they will get over them. Now, dollar weakness should help. Now, this is what we're talking about when we're talking about our tech sector going, hog wild here, running into earnings. The typical S&P 500 stock gets about 40% of its sales overseas. So converting those sales into a strong dollar was a big drag in 2022. Fortunately, the dollar has declined since September, so that drag is less onerous. The dollar fell 7.7% last quarter, so sequentially companies should experience some relief. However, the dollar remains higher than last spring, so year-over-year results will remain under pressure until Q2, assuming the dollar stays where it is or declines further. So right in this quarter, we're probably not going to see all the year-over-year dollar weakness that we were expected to see in Q2, but it should help at least quarter over quarter, maybe not year-over-year. Overseas revenue varies from sector to sector, but the dollar's impact is greatest on IT stocks. About 58% of that sector's sales are outside America. International sales account for 42%, 44%, and 55% of communication services, staples, and materials revenue. So they can also benefit from the dollar slide. So look for some of these stocks from these sectors to run into earnings. That's what I would expect. Falling commodity costs and moderating labor costs may also help profits from this year. Can you imagine if you've gone through all these rounds of layoffs and your company is still selling goods at a rate similar to last year, but your cost for labor has gone way down? We would expect that the earnings aren't going to be that very heavily impacted. Actually, they could have a larger profit margin than they were having this last year should revenues hold up. And there's no reason to believe that they won't hold up, at least to some degree, because the unemployment rate is just so low. People have jobs, they're going to spend money. It's just kind of the way it works. So commodity costs are falling. The Invesco DB Commodity Index has fallen from $31 in June to $24 now, so it's about back to where it was trading in March. The decline suggests commodity costs should be sequentially manageable with the potential to support margins as soon as Q2. So not only are we going to get less labor costs, there's also going to be less input costs. So these earnings could really hold up this year. It all remains to be seen, but Q2 seems to be what we're talking about. So we're talking about when they're going to report earnings in July. That's what we're talking about there. So it's the April through June quarter. It's the reason why you hear so many people saying the first half of this year is going to be awful and the last half of this year is going to be great, because they're picturing that the last half of this year is when all of this stuff gets fixed. It's because we're going to go from inflation to earnings. Inflation's going to come right back down, and then earnings are expected to start going up. The latest labor cost data suggests it won't be as big a headwind as it's been either. Headcount reductions are happening at many high-profile growth companies, including tech companies. Also, fewer hours worked and stable year-over-year wage growth resulted in average weekly earnings growth of 3.9% in November, down from 5.3% the previous year and 4.2% in September. I think that what's happening is that you're having a lot of these bigger companies that are laying people off. I have no way to prove this, but what I think this is what I think is happening. They're laying people off. And what's happening is that, these companies like Microsoft, Google, Apple, and the like, they give you more compensation. They give you bigger benefits, if you will, healthcare benefits. And so a lot of workers flock to those companies. Now, when they lay you off, now some of these more Main Street type companies that maybe don't pay you quite as well and maybe don't give you quite the benefits. However, that job is better than no job. And so they're going to these companies, and that's what's bringing wages down, even though unemployment's not really going down. And that's what I think is happening. I think that workers are going to slightly lower paying jobs, which is keeping the unemployment down, but earnings growth is also coming down as well. So what's the smart play? The prospect of lower earnings is worrisome because valuation depends on the multiple investors will pay for earnings and the absolute earnings level. If prices are constant, declining earnings estimates increase the forward PE ratio, making stocks appear more expensive. If interest rates remain high, then the risk-free treasury yield reduces the multiple investors are willing to pay for future cash flows. The 1-2 punch keeps a lid on valuations, capping the upside. That said, valuation isn't ridiculously high now that stocks have retreated. The S&P 500's forward PE ratio is 16.5, up from 15.2 in September, but still below the 10-year average of 17.2. If earnings wind up better than feared and the Fed puts the brakes on rate hikes after February, which is a possibility, which is what the market's actually pricing in. Now, the Fed thinks they're going to hike up through May, but the market thinks it's going to be February. Then early cycle stocks like technology may find their footing. The current full-year S&P 500 consensus earnings forecast works out to $230. Let's just briefly review exactly what that means. So what we're saying is that right now the S&P 500 is at $39.99. We'll call it 4,000. And the current forward price to earnings ratio for large cap stocks is 17.4. So if you bring up your calculator and you put in your S&P number and you divide it by the forward price to earnings ratio of large cap S&P 500 stocks, which is currently 17.4, we can see that the S&P 500 is trading at $229.88 a share. A lot of your more pessimistic analysts would have this number coming down below $200 this year. I don't think it's going to be that way. I think that it's actually going to decrease a little bit between now and say the middle of the year, but it will go back up by the end of the year. And I think it will end up over $230 a share. And at $230 a share and interest rates about where they are right now, I don't think that 17 is actually an unreasonable forward PE ratio for the stock market. So I'm kind of expecting the market to be flat for about the next, I don't know, through June, and then actually tick up a little bit after July and start just not a ton, but it'll go up and finish the year maybe around 4,300. I think that's reasonable. So the current full-year S&P 500 consensus earnings forecast works out to $230. If we assume a range of $220, representing roughly no EPS growth in 2023, to then leave it at $230 and a PE multiple of 15 or 18, then a loose S&P 500 range would be 3,300 to 4,140. Of course, analysts' expectations for S&P 500 earnings vary. For instance, JP Morgan thinks S&P 500 will be just 205. Again, I'm just more bullish than they are. I tend to think it's going to be a little bit higher, but it is, I would probably take JP Morgan's word over mine. I just tend to think that we're going to get a little bit of a pivot and this market will end up higher at the end of the year than it is today. Overall, watch earnings reports closely over the next few quarters. If profit margin pressures ease because of fading dollar headwinds, easier labor costs and lower commodity prices, overly bearish earnings estimates could allow more companies to beat than miss as the year progresses, propelling stocks higher. I think this is a great article, and it kind of just like outlines, gives you a nice forecast for the rest of this year. At least allows you to draw your own conclusion of what you think is going to happen for the rest of this year. Now, in the short run, I'm afraid that I think things might come down just a little bit. This is going to be our chance to go down. That's because of this VIX here. When the VIX is high, it means that stocks are going down. And when the VIX is low, it means stocks are going up. And if you look at the way this thing has been trading for the last year, you can see that we're at a very low point right now in the VIX. Now, if all you did was sell the market when the VIX was 18 and buy the market when the VIX was 35 or so, you'd be very rich today and you would have had a fantastic year. So right now would be, according to this past year, a great time to sell. But, it remains to be seen. You don't really know. But if you had done this over the past year, this is an indicator that you should probably be trimming some stocks and taking some profit. And that's the way I'm kind of playing it right this second. So let's look at what I am doing with my own portfolio right now, just to kind of like navigate through these waters a little bit. Now, like that last article said, with interest rates where they are right now, short duration fixed income seems to be something a lot of people are going into. Now, it's not something that I really am interested in, but if you are, here's how you do it. If you have a Schwab customer, you just go to trade. Instead of going to say stocks or options, you go over here to bonds. And it'll allow you to actually buy some short duration treasuries. So here's the 3-month, it gives you about 4.65% yield, and the 6-month gives you 4.78. And so this is really nice. So if you let it go to maturation, you're guaranteed to get your money back plus 4.65%. So that's really good. But again, I'm not really that interested in it. And you might also hear people talking about how they're interested in investment grade corporate bonds right now. I can't find anything that I find very intriguing, but here's some ETFs on some investment grade corporate bonds. This one's from Fidelity. It's called FIG-B. It's selling for $43.66 a share. You can see it's down 11.13% over the course of a year. Not surprising because bonds have been taking a beating. It pays out monthly, but it's only a 2.45% payout per month. So it isn't something that interests me. It's like the holdings in this are going to be treasury notes, and then you're going to get some, of course, investment grade companies such as Bank of America, Citi, NatWest, and the like. But this isn't very intriguing to me at all. Another investment grade corporate bond ETF would be LQD. That's from iShares. They sell for $110 a share. They're down even more than the one from Fidelity. They're down 13.65% over the course of a year. They pay a 3.3% monthly 3.3% annual paid out monthly dividend. And so maybe it works out to be about the same as Fidelity's. They hold other, basically just pure investment grade companies such as BlackRock, Anheuser-Busch, CVS, T-Mobile, Goldman, and the like. So these are things that you could do, or these are things that they're talking about doing. You can see that this actually has a 2-star rating from Morningstar in the short overall. 3-year rating is 1 star, 5-year 2, and 10 years 3. This isn't something that I recommend going into. As a matter of fact, I don't recommend it. I think these are trash. Okay, but what I am going into instead of bonds or some of these investment grade corporate bond ETFs is going to be JEPI. And if you follow this channel, you know I do love myself some JEPI. It is down, however, 9.36% over the course of 1 year. But the difference between this and some of these other investment grade corporate bonds or even the US Treasuries is that this one pays out 11.68% annual dividend that is paid out monthly. They have their holdings there that are AbbVie, Progressive, Exxon, MasterCard, and the like. But in addition to that, they're also a covered call ETF, and they have 15 covered calls open on the S&P 500. It's the way they're able to generate such a nice return for you. So what am I doing here? Well, right now my entire portfolio is basically JEPI and cash. And so I'm doing JEPI right now, and I've got about 1,900 shares of that. And I bought it about $54 and change. I don't know, I checked the last video. I don't remember what it was, about $54.20 or something like that. And so what you can do once you own this is you can actually sell covered calls against your own covered call ETF, which is what I've been doing. I don't have any open at the moment because I'm afraid of losing these shares, because what I really want is that dividend. And on $100,000, it's $1,000 a month, so it's pretty good. So if I take this and I have a strike price of $56, right now it's sitting at $55.70. What I'm saying is if by January 20th, which is next Friday, if JEPI is over $56, let's say it's $56.10, I'm going to have to sell all of my JEPI shares for $56. And for that, someone will give me $13 per contract. I have 19 contracts of this. So if I was able to get the full $13 or 13 cents a share or $13 a contract, and I was able to do it for the 13 cents, it would give me $247. I add that to the $1,000 that I was already going to get, and now I'm going to get $1,247, which increases my premium even more. It would be great if this traded weekly options, but it doesn't. It actually trades monthly options, and it actually excludes, it won't let you buy or sell March, and it won't let you sell May or June yet. I imagine that you will have a March option expiration, and you will have a May and June expiration, but that you'll have to get that a little bit, right before it happens. Maybe, I don't know, but for right now, I'm trying to get a little bit of extra money out of JEPI by selling covered calls against my covered call ETF, and I'm going to do that as well. So the other thing that I'm going to be doing is I'm actually also looking very strongly at the energy companies. And so what I'm trying to do is I take something like Exxon, and I'm going to go ahead and sell a put. Let's say that I really want Exxon at $112. And so let's say that if by January 27th, if Exxon is trading at $112, or below $112, I will agree to buy this for $112. I'll sell this to open. Somebody will sell me this contract for $149 because they think that Exxon will be below $112. Let's say $111.50. I don't care. My break even, if I'm going to get $1.49 per contract or $149 or $1.49 per share, or $149 per contract. If I subtract that from 112, I'm actually buying my Exxon Mobil stocks for $110.50. Energy is projected to have a good year. I have no reason to believe it won't, so I don't mind picking it up for $110.50. Another thing that's going to happen is this Monday, Morgan Stanley and Goldman Sachs are actually reporting earnings. I'm expecting to be pretty mixed bag, similar to the other bank stocks that just came out this past Friday. I'm not interested in trading options on those. If I was interested in trading options on those, I would go over here to Goldman Sachs, and for $374, I'd say, okay, let's go ahead and sell a put on this and see what price do I not mind owning Goldman Sachs for. It trades at a price to earnings ratio of about 9.5. Maybe I want to pick it up at 8. So let's go ahead and see that maybe I want to get this for about $360 a share. Well, if I want to buy Goldman Sachs, and I thought it was going to fall $14 on earnings, and it very well could, though I don't think it will. I think it's actually to bounce a little bit. I could get $123 per contract. And all I got to do is hit sell that to open, sell a put. Now, if Goldman Sachs falls to $355, I just bought it for $360 per share. The break even on this is going to be $358.77. And so I would actually be paying more than what I would like to pay for this, but that's just a chance I take. I could always buy myself out of this contract, but if I really wanted Goldman Sachs and I thought this was a good price, this might be something I consider. The Exxon Mobil is actually something I consider at $110.50. I think that's a good price. I don't mind buying it there. I don't mind selling that put, and that's going to be part of my strategy going forward. Now, also reporting earnings this Friday, it's going to be Schlumberger, or now called SLB. This might be one that I actually make a play on, is going to be SLB. And for this one, I might sell a put. It's trading at an all-time high right now of $58.28. Don't mind doing this right at the money, because I think their quarter is going to be lights out. And because other people think it's going to be lights out too, you only get $94 for selling this thing right at the money. And so I just go ahead and I put this in for $94. And if I want to buy Schlumberger, I'm going to do it for someone will pay me $94 to hold this contract, and then my break-even price would be $57.06. I have no reason to believe that this stock is going to go down at earnings. I think it's going to go up, and so I could actually get Schlumberger. I think this is like money in the bank, really. $94, selling it right at the money here at $58. I think it'll be up over $60 after earnings. So yeah, so that's what my plan is, to get money out of this market. I think it's going to be choppy. It's going to trade sideways. It's going to be range bound. I'm going to be getting 11.5% dividend out of JEPI. I'm going to try and grab little bits of money where I see there's an opportunity, such as Schlumberger, such as Exxon Mobil. All right, well, that's going to do it for this week. Before I go, I'm going to have to give a quick shout out to Dave and Bob, retired in 2020. Paul Rizzo, check out his channel at Paul Rizzo Investing, and JFR. You know what? Cheers, you guys. Thanks for watching. And this here beer is Yard's Pale Ale, Philadelphia Pale Ale. I really like it. I'm kind of easy to please when it comes to beer, but I'm just going to have to give this beer 5 K Roonies out of 5. Have a great week, everyone. Bye.